international taxation. She has advised multinational corporations and regional businesses on inbound and outbound tax structuring, cross-border tax planning, contract-level tax optimization, and business restructuring. She has led several engagements across sectors, including manufacturing, trading, financial services, real estate, and energy. A chartered accountant also holds a advanced diploma in international taxation (EDIT) from the Chartered Institute of Taxation UK and has played a key role in implementing tax regimes and regulatory frameworks in both UAE as well as India. She currently leads Deloitte's UAE's incentives on UAE R&D tax incentives, helping businesses assess eligibility, maximizes available incentives, and navigate through end-to-end claim process. So we would like to welcome her and put a stage on her to showcase this presentation on research and development tax incentives. Welcome.
Yeah, thank you, Smith. Thank you for that introduction and good evening, everyone. And it's truly a privilege to be the first, I think, tax technical speaker for this focus group. And I hope today's session will set the tone for the kind of rigorous and practical conversations this group aims to have going forward on various topics. As Chintan was mentioning, there are so many topics in corporate tax where we can zoom in and deep dive. So I hope this will be a good start. So Smith, will it be possible for you to share the slide deck for participants? So while you do so, to kickstart, why this topic? Many must be wondering why this topic and why now. So UAE R&D incentives are particularly timely, I would say, with the introduction of corporate tax and the government's ambition to diversify the economy and drive innovation-led growth. R&D incentives are quickly becoming one of the more strategic and yet still, I would say, underutilized tools which are available to businesses. So the tax rate, as we all know, in UAE is 9%. So generally, either the governments keep the low tax rate with no incentives, not much benefits, or they keep the low rate, high rate, and then give a lot of incentive. So because UAE is a low rate corporate tax regime, so we don't expect that there will be many or several tax incentive benefits. So whichever is available like this R&D, the businesses should definitely make use of this. So as we will proceed, you will see there are some work required, effort required, but in spite of that, it's a very good regime. If businesses can do that and manage that, there can be a good incentive and good tax deduction in terms of even the ETR which they can achieve. So before we get into details, I would like to flag something upfront because that is what we have been observing this. So I'm leading, as Smith was mentioning, R&D initiative, and we are meeting a lot of clients. And we still feel and we still observe that this incentive still remains a bit underclaimed or less talked about. And that is also because when people hear R&D, the image that comes to mind is usually a white lab coat, a scientist, a laboratory somewhere. And the instant reaction is whether you are in practice or you are sitting in an industry finance function, is that this does not apply to us. We are not a pharma company or a tech lab. So that assumption is exactly what we would address today. R&D for tax purposes is not defined by who you are or what industry you are in. It is actually defined by what activity you are doing. For example, a logistic company solving a technical problem in its supply chain process, or a manufacturer developing a new formulation, even for a financial service company building a novel risk model. All of these can potentially qualify. Although these are not those traditional R&D kind of examples you will think about. So whether you are evaluating this for a client as a practitioner, or if you are, for your own organization, if you are an in-house finance or tax person, I would encourage all of you to not think about the industry labels, but about the technical uncertainty being solved from day to day in your businesses. By the end of this webinar, I hope many of you will walk away seeing R&D potential in places there that you may not have considered before. So with that in mind, so we will start the session. We will look at the, broadly the international perspective on where UAE stands. Then we will touch on the policy backdrop and how the UAE has introduced this incentive, the eligibility criteria, and so on. So with that, and then we will of course have a time for questions also in the end. So do note them down as we go. So we can move on to the next slide. Okay. So let's not start with the UAE, but let's zoom out a bit because it's important to establish upfront that R&D tax incentive are not UAE specific or first time UAE's invention, and they are not experimental. It is a well-tested, globally adapted policy tool, and looking at how the rest of the world has used it gives us a useful lens for what to expect here. So R&D tax incentive today exists, I would say, in over 50 countries. So UAE is not the only one. There are many countries who have already introduced it in some form or the other. And this is not limited to a handful of the tech forward nations. Virtually all major economies have in some form or the other. For example, UK, US, EU, most of the EU countries, China, Singapore, even India, in some way or the form it is there, and the list goes on. So the UAE, in introducing this, is really joining a well-established global consensus rather than pioneering something which is untested. Now we can stay on the previous slide. Now, the design of these incentives varies quite a bit from country to country. If we look at the benefit rate, that is effectively how much relief a company gets on qualifying R&D spend, it can range anywhere from 1% to 50%, as we are seeing in UAE, the upper tier is 50%. So it may depend on the jurisdiction and the specific scheme. And on an average, if you see, we are looking at somewhere in the range of 16 to 19% range where this R&D benefit is applied globally. The structure of these incentive also differs. It can be expenditure based, income based, revenue based, tier more directly to generated revenues, or it can be targeted incentives for particular industry or particular size of industry, SMEs, or it can be a general more broadly across the economy. Of these, expenditure-based incentives are by far the most common approach globally. And as we will see, this is also the model the UAE has adopted. Now, the natural question which comes is whether this actually works, whether this gives a tax incentive really more the needle on innovation. So, is it just relief for spending that would have happened anyways, or based on various data available on OECD, there is something where the needle is actually going towards the innovation because of this incentive. So the data as OECD has presented is quite encouraging, and it shows that if those countries who have introduced this incentives, there is a genuine innovation spent increase. So it is not it definitely changes the behavior of the businesses, and they try to bring the innovation and spend more on that. So with that, we'll move on to the next slide about the legislative introduction, how in UAE it has been introduced. So now let's trace how it has worked in UAE, because the legislative journey itself tells us something about how deliberately this has been rolled out. So the starting point is, of course, our own CT decree law, which is the federal decree law number 47. In the corporate law itself, if we see some of the articles, for example, Article 20, Article 44, and Article 49, they talk about the tax, certain tax incentive, although they don't name R&D, but they talk about generally about the incentive and how they should be looked at. So 20 talks about the R&D the incentive which could be, adjusted in the income. So that would have been for the incentive which are income based. And 44 and 49, you can say, are more credit driven incentives. So it's already plugging in those processes and those parameters within the city law, where if those kind of incentives are introduced, they can be claimed and can be plugged into the overall UAE corporate tax and its procedures. So with that, in many ways, the framework was designed with the possibility in mind, I would say, from the day one when the corporate tax was introduced. This was the basic framework of the provisions in the corporate tax law. And then the next milestone, as we all know, or most of us will know, was the public consultation process, which the Ministry of Finance ran in April 2024. So this document was released and the feedback was invited from various stakeholders. And it is worth appreciating that the regime we are about to discuss was possibly shaped in part by the practitioners and industry feedback alike. So following this consultation, Ministry made a formal policy announcement in December 2024, confirming that R&D credit would be introduced. And after that, the actual legislative instruments were issued. Cabinet Decision number 215 of 2025, which laid down the overall framework or the legislative architecture with various definitions and the way the R&D credit will overall work, and followed by the Ministerial Decision 24 of 2026, which fleshes out the operational details, how in detail it will work, the credit rates, the qualifying activity criteria, the anti-abuse provisions, and all. So together, these came into effect for the tax period commencing on or after 1st January 2026. Now let's see in detail how it works. And before we start, let's see, take a step back and look at the incentive at a high level. Before we get into the detailed mechanics, let's think of this slide as one page summary. If you remember nothing else from today, this is one slide you should remember, because this will give you a good head start and a good idea what this R&D tax credit is about. So in the big picture, what exactly is this incentive? It aims to encourage private sector R&D activities within UAE. So local activities is a prerequisite. It has to be local. And at its core, the UAE tax incentive is structured as a tax credit. It is not a deduction from the income. So we all should keep that in mind. It is more like in more commonly we call it as a super deduction. So you will have all the R&D related expenses as business expenses already sitting in your profit and loss, which you would be already claiming from your taxable income. So that will remain as it is, that is not impacted. This credit is over and above those deduction of the expenses. So it's a super deduction. And that distinction matters as the deduction reduces your taxable income. So the value depends on the tax rate. A credit, on the other hand, is a direct dollar for dollar, or in our case, say dirham for dirham, reduction of your tax liability. And that makes it a considerably more powerful and more certain form of a relief. So, especially if it is a non-refundable R&D tax credit available up to 50% of qualifying R&D expenditure, this is really a good incentive to really look for and see wherever there is a possibility to claim. Now, how does this apply or to whom it applies? So, it applies to all UAE resident juridical persons and even the free zone entities, foreign entities, permanent establishments in UAE. If all these companies are paying taxes, corporate tax or pillar two taxes, and they are undertaking R&D activity in UAE, they can claim this credit. So it is not restricted to mainland companies or free zone businesses are also covered, which actually surprises number of people, because when we meet, clients, they are not aware that it may even apply to free zone persons. Although the applicability could be depending on very fact specific circumstances, but there could be a good potential that free zone entities may also claim the benefit. And next, as we see on the slide, is how it works. So credit sits within and interacts with the broader corporate tax framework. Since qualifying entity determines the eligible projects and the eligible expenditure for the tax period, the credit is computed and then it can be used to offset that entity's corporate tax liability or even the top-up tax liability, which is a deliberate design choice to make sure that the incentive retains real value, even for large multinational groups who are within the scope of Pillar 2. So that is how it is. And even if you cannot claim full credit, it can be carry forward for indefinitely and it can even be transferred. So this is how broadly the framework of the R&D tax credit is. So with that in mind, let's see, go further in the next slides and see how it works. So before we move ahead on this slide, just wanted to briefly flag that Cabinet Decision 215 and Ministerial Decision 24 which are the R&D specific decisions, are fairly detailed, and they define quite a comprehensive set of terms. What constitute R&D, what qualifies as an R&D project, what is meant by R&D staff. So all those are defined, and many more terminologies. So I'm not going to read out or explain in the interest of time each of these definitions individually. That's not the intent of this slide. I just wanted to give a flavor, and for you to walk away and appreciating that these instruments or these decisions are fairly exhaustive and are well thought through in how they define the various building blocks of this regime. So, in case any one of you want to get into more granular details, even after this presentation and want to go deeper afterwards, you know that these are a detailed one and these are the decisions you should be looking for the details. So moving on to the next slide, after covering these definitions, let's see how the broad process will look like. So as you can see on the screen, we can break the entire process into 4 broad steps. So step 1 is identifying the qualifying R&D activities. This is actually a technical assessment. It starts with identifying the entity and the specific projects, and then confirming that the activity genuinely meets the prescribed conditions under the regime. We'll see in the next slide what exactly those technical conditions or parameters are. And it has to satisfy, all those conditions, which is based on Frascati manual issued by OECD. Once that is established, the entity needs to prepare for the pre-approval from the council. So this is not a self-certify or self-assessment claim process. There is definitely a pre-approval process or a gatekeeping step upfront. So you take the approval from Emirates R&D Council, and then only you can claim. So that is step 1. Step 2 is determining the qualifying R&D expenditure. Here the entity identifies which expenditure categories are eligible. It can be staff costs, consumables, and various other related expenses which are directly for R&D, and calculate the qualifying R&D expenditure. You aggregate all the expenditure and see what is the total expenditure for that project. It's also important to confirm the expenditure crosses the minimum threshold, which is 500,000 dirham for each project. And there is also a limit, and in terms of number of employees and all that. So all that has to be also evaluated. Documentation is critical. Supporting evidences are critical. So ensure proper tracking that ties the expenditure directly back to R&D activity itself, not just at the entity level, but at the project level itself. So that is the step 2. So firstly, you do the technical assessment, then you determine qualifying R&D expenditure, and step 3 is then determining the tax credit. So there is a tiered formula, as we will see further when we will go in the presentation. After the expenditure is established, the credit is calculated, applying those rates and those tiers. And then once it is spent, then it depends also on the staffing profile, and accordingly calculate the exact amount which is eligible for the credit. And step 4, and the last step you can say, is that the credit can be applied against the entity's corporate tax liability. Again, I will emphasize, it is a credit against your corporate tax liability. So if the corporate tax payable before this credit is say 1 million for an entity, and the benefit under this is 200,000, you straight away reduce your corporate tax liability by that 200,000. So instead of paying 1 million to the tax authorities, you pay 800,000 after taking this incentive. So this is how is the 4th step works. And if something still remains, say for example, in this same example, my credit was not 200,000 but 1.2 million. In that case, my tax liability was only 1 million. My eligibility to claim credit is 1.2 million. So 200,000 still remains to be claimed. I can carry it forward indefinitely and set it off in future years, or I can even transfer to other group companies depending on certain conditions. Sorry. So it's worth being precise with this distinction. By evaluating this incentive, it is non-refundable and non-transferable, because both are sometimes used loosely or interchangeably, but they are not the same thing. So some jurisdiction do make this refundable incentives. So you can actually go and get a cash refund from the government. But so is not the case here. It is not refundable, but it is transferable. Yes, moving on to the next slide. Yeah, key concept. So this is the key slide, but this is the slide I think most of us, even when we will get into the R&D tax incentive assessment criteria, we are the one who will spend the least amount of time, but we will have to do a lot of collaboration with various other technical teams. So let look at how to do that assessment or technical statement from technical standpoint. So we are all tax and finance people. We are not, you all will agree, not technical scientists or engineers. And when I say this, because I'm sure most of the people in the room are in the same boat. We are either in, whether in practice or industry. So the good news is you are not expected to make this call, this technical call alone. Firms like Deloitte have dedicated technical assessment teams to do this exactly the same purpose. Even those who are, within the organizations, the R&D departments will have own technical or engineering persons who can help assess this. So our role as tax and finance professional is to know what framework this assessment sits within, so that we can ask the right questions. We can work alongside those technical experts and the right team members, and then see the assessment and to conclude whether we can claim this R&D tax credit or not from technical perspective. We don't need to make that technical call ourselves. It's a collaborative effort, and these technical people will help us making that assessment. So as you can see on the slide, the assessment is as per the OECD's Frascati manual. So what is OECD Frascati manual? Because most of you would have heard this name when this R&D tax credit was introduced. So it is an internationally recognized framework, and it is used globally to define and measure research and development, the various terminologies, the various assessments, how it is to be done, so that there is a consistency, whosoever is evaluating R&D framework. And it underpins how most countries, as we discussed earlier also, US, UK, and various other European countries, how they define their R&D aligned to this Frascati manual, so that nobody is creating their own definitions, and then you can't compare globally with each other. And under this framework, an activity must satisfy these five core criteria, and the satisfaction has to be for all the five, not just some of them to qualify. So first one, as we see, first is novel. So the work must be aimed at new findings. It is not something already known or in use. Second is creative. So creative, it must be based on original concepts or hypothesis, not just routine application of existing methods. Third is uncertain. There must be a genuine uncertainty about the final outcome. It is not a predictable result using established techniques. It should be systematic. So the work must be planned. It should be budgeted, following a structured approach rather than something which is an ad hoc effort, or just by accident you did something. Transferable or reproducible, that is the last condition to be satisfied, or the last parameter of the technical assessment. The project methodology and the result should be capable of being reproduced or applied elsewhere. So in short, if it's a routine, predictable, or just standard operating procedure, it will likely won't qualify. However technical it may sound, but genuine problem solving under real uncertainty, even if seemingly non-technical, may very much can qualify. So this is exactly why technical assessment matters so much. And this is why partnering with the right technical expertise, or whether in-house or external, is critical part of building a defensible claim and doing the technical assessment. Moving to the next slide. Yes. So on the slide, you can see that there are, some examples, what may qualify as eligible activity and what may not qualify as eligible activity. So what will not qualify is very easy to see: routine or periodic changes, cosmetics or aesthetic improvements, standard software implementation. These are all, on the right-hand side are the examples which will not qualify as R&D. What may qualify as an R&D are experimental development, prototyping, testing, iteration, product development, applied research for practical application, process innovation, enhancing production or delivery methods. So these are all, and irrespective of the industry the company or the taxpayer is in, whether it's technology, manufacturing, healthcare, financial sectors, or any other sector. It is not tied to any sector. It can be anywhere, provided these activities are being undertaken. Yeah, moving on to the next slide. Yeah. Now we have talked about that this is expenditure based, and you have to calculate the qualifying expenditure or the cost. So what exactly those costs are and how it is computed? What are the key parameters which needs to be taken into account? So first thing first, as you see in the center, minimum AED 500,000 for each R&D project in each fiscal year is a basic requirement. So the total of all the eligible expenditure should be minimum 500,000 AED for that project in that particular year per taxable person who is claiming the benefit. And what are the kind of cost which will be included? Staff cost. So staff cost with an upliftment of 30%. So staff cost also we will take the breakdown. We will see that because it is important. So I will spend some time on staff cost also. So staff cost has a upliftment of 30%. So if 100 is your staff cost, you can straight away add 30% to that. So your staff cost will be considered as 130, which is a very good an enhancement given by the law. It excludes stock option plans or any intra-group recharges within a particular tax group. It includes consumable cost, the qualifying expenditure for R&D, cost of consumables, transferable materials, any license paid for any intangible for the R&D activities. Even if it involves payment to participants of clinical trial, it will be covered in consumable cost. It excludes, of course, the material or items which will be disposed of in the ordinary course of business for consideration. Subcontracting fees is also included. So as we see, it's very common that under R&D we may outsource or subcontract some of the activities. So even that fees is also, you can consider as qualifying expenditure, subject to, of course, few conditions we will see again in the subcontracting section. And even if the R&D is not done by that company individually or alone as a standalone, even if they are joining hand with other, sometimes it can be universities, sometimes it can be within group companies. So even if there is a cost contribution arrangement where more than one, person is coming together to undertake the R&D activity, even that cost, the share of the cost of this person or the taxable person can be considered as an expenditure, provided it satisfies all the various conditions and that expenditure or the share is aligned or proportionate to the benefit this person will get out of the research and development outcome. And of course, if this is done with the related party, then a precondition is that it should be whatever you are sharing the cost and everything is as per the arm's length. So these are the various expenses which can be considered as qualifying R&D expenditure. You add all these expenses and then you apply the percentage basis some tiers which we will again see, and that is the amount you take credit from your tax liability. And these expenses, some underlying conditions which they need to satisfy is that they should be wholly and exclusively incurred for the qualifying R&D activities. If they are shared, then you have to apportion it. They should be deductible under corporate tax law. So if there is some expenses, say for example, penalties, you might have paid certain penalty, but that penalty is not deductible under the normal provisions of the corporate tax law. So similarly, you can't consider that as a qualifying expenditure. So whatever expenditure is being considered out of these four buckets, what we saw, should be deductible under the corporate tax law or the cabinet decision number 142, which is pillar 2 provisions. Those expenses should not be funded by grant, or they should not be subjected to any other incentive, credit, exemption, or any other facilitation. So moving on to the next slide. Yes. So if we see the eligible cost and computation, outsource, you can also do outsourcing, but of course, outsourcing cost is one thing, but when you outsource, there are few conditions. Only if you are satisfying those conditions, then only R&D cost you can consider as qualifying expenditure. So what are those conditions? One is there is a geographic restriction. That means the subcontractor must be based in UAE and the activities must be undertaken in UAE. So if any part of the activity is undertaken outside UAE, that cannot be considered. So as we call it, boots on the ground. So all these activities has to be in UAE, whether you are directly doing it or whether your subcontractor is doing it. In either case, it has to be done locally in UAE. There should not be any chain of subcontracting. So activities which I have subcontracted to another party, that party should not further subcontract to anyone else. That should be the direct party who will undertake that for me, these activities. And these activities are should also not be subcontracted to the qualifying entity by another party. So these are the two key conditions in terms of chain of the subcontracting. Even related party rules. So in case the other party or the subcontracted party is a related party, then there is a specific requirement that this other subcontracting related party account should be audited. Their financial statement should be audited. And both the parties should do all the transactions under arm's length basis. If in case of a certain expenditure or some outsourcing is done or allocated to a foreign permanent establishment, then that will not be included because of the same geographical restrictions. So subcontracting between members of the same tax group does not consult a qualifying R&D expenditure because of the we are all tax professional. We all know how the tax group work. Tax group is considered as one taxable person. So any intergroup transactions are eliminated and it is only considered once, whatever is the expense. So keeping the same concept in mind, the subcontracting cost between the members of the same tax group cannot be considered separately and added together as an expense. Those needs to be eliminated. Yeah, moving on to the next slide. So cost allocation and apportionment. What is apportionment? So in case the cost or the expenses are not only for the R&D activities, we are sharing the cost with maybe other departments or other projects. Maybe it is exclusively for R&D, but there are two projects of R&D going on. So the cost is incurred for both the projects. So in these kind of a cases, there will be an apportionment which will be needed. Some example of such cost could be employees who may be working part-time on R&D activities, part-time on other projects, commonly used material or licenses, shared resources across multiple R&D projects. So generally the common methods of allocation which are commonly acceptable should be used. It can be time-based allocation, supported by timesheets or project log sheets, usage-based allocation supported by proper records, cost centers and project codes incorporated in the ERPs. So these are the various methods which can be utilized. If there is any other method, depending on what type of cost we are allocating, and there is any fairness and reasonableness, even that other method can also be used. The R&D provisions as such do not define that what method should be used. It says fair and reasonable. So wholly incurred for R&D, if more than one purpose, you identify the part which should be considered, and allocation should be on reasonable and reasonable basis, and it should be followed consistently. So you can't keep changing the basis every year. So once you are doing, say, for example, on time-based allocation, do that every year, unless there is some very valid reason for you to substantiate the change in one of the years. Sorry about that. So these are the various tiers on the basis of which you calculate the eligible cost and the amount. Smith, I think we missed one slide, is it, on the salaries? Can you go back? It didn't come. Okay, no, it should have been. Okay, anyway, let's move on. I will cover that up. So this is the three-tier approach or three-tier basis on which you calculate the R&D tax credit amount. And there are caps. So it is important to see the caps because even if you are incurring certain expenses which is more than the cap, you may not get any incentive benefit because the law does not allow more than that cap. So if your qualified R&D expenditure, which we just saw in the previous slides, addition of those four cases: salary cost, consumables, um, the shared cost, and outsourcing. So when you add all that, you get the total bucket of the R&D qualifying expenditure. And if that total is less than 1 million and the average R&D staff involved in those projects are at least two or more, then you can claim 15% of that expenditure as a deduction from your tax liability. Now, if the same expenditure is more than 1 million, but less than 2 million, so in between 1 and 2 million, and average R&D staff is equal to or more than 6, then you can actually apply 35% of the expenditure and claim that as a deduction from your tax liability. If this qualifying expenditure is more than 2 million, but less than 5 million, 5 million is the overall cap, but the average R&D staff is equal to or more than 14, you can apply 50% of that expenditure and then claim that as a deduction from your tax liability. Now, if any company has expenditure of more than 5 million, say 10 million R&D expenditure, currently you cannot do with that anything with that additional expenditure because the cap is at 5 million. That balance 5 million goes in a way from R&D perspective wasted. You can claim the expenses as a deduction under the normal provisions of the tax law as a business expenditure, but that cannot be considered for R&D tax incentive. You stop at 5 million at a higher cap. And then it's a progressive deduction. So you add in the 1, 2, 3, and if you add all the three, the total will be around 2 million. And that is the 2 million cap you can claim against your tax liability. If you can claim full, well and good. If cannot claim full, you can carry it forward, transfer to other entities. So both the expenditure threshold and the minimum R&D staff count must be met simultaneously. If one of the threshold is met, say for example, if we see you have an expenditure of 5 million, but your employees number is only 10. In that case, you cannot be in the 50% bracket. You have to go back to the previous slot where both the conditions are satisfied. So in the previous slot, you will satisfy that the expenditure is more than 1 million and the staff is more than 6. So then you will apply 35%. So both threshold has to be satisfied simultaneously. Go on to the next slide. Yeah. So this is an example which will, I think, clarify how exactly it will work. So total R&D expenses assumingly is say 1 million. It is a gross engineering and say development project. And net non-eligible expenses 300,000 out of this. You can say because this relates to some items which are related to social sciences or intergroup recharges. So you exclude this 300,000. So the eligible R&D expenditure will be 1 million minus 300, 700,000. Now, if the 700,000 itself consists of a staff cost of 500,000, you will apply that uplift of 30%, which we saw in the previous slide. So this upliftment will give you additional 150,000 as a staff cost. So your total cost will become 700,000 plus this 150,000 upliftment. So 850,000 as a total R&D expenses. And this is the amount which you will then apply 15% in this case because of the thresholds. It is less than 1 million and say the number of employees are 2. Then you take the 15% of this qualifying expenditure and 127,500 in this case is the amount which you will get a direct credit against your tax liability. So this is practically how this R&D will work. Moving on to the next slide. Yeah. Okay. Just go back to the previous slide just to tell you what exactly the employee cost will be. So the employee cost will be salaries, allowances, insurance, bonus, even if you are incurring training for the R&D staff related to that project, even that training cost will also be included. So all these costs you add up and then you apply 30% upliftment. So that will give you a total staff cost. And only thing which is excluded here is the ESOP cost. If any employee stock option plan is there, you cannot consider that as a staff cost. So that is how you calculate the staff cost. Yeah, now we can proceed to the next slide. So in terms of utilization rules, so once you have the tax credit amount and you want to claim it, so of course the primary offset is you offset against your current corporate tax liability or your topic tax liability, depending on what your facts are. If you do that fully, well and fine. If something remains, you carry it forward. So when you carry it forward in the next year, again, the next year, firstly, you offset the current year R&D incentive if something is there. If not, then you follow FIFO method. So if you have been carrying your tax credit for few years, then you offset the oldest one first, and then accordingly you proceed. Similar rule applies even for the tax groups. You can, apply again, use against the current first, the current R&D credit. If something remains, then you do it later on a FIFO basis. Any pre-grouping R&D credits are also can be used, of course, first, and then you move on to the other credits. For Pillar 2 also, firstly, you have to take the credit against corporate tax. So you cannot go straight away to the Pillar 2. You reduce against the corporate tax and something remains, then you can use it against the Pillar 2. So here it can be actually very beneficial for certain free zone companies. Many Pillar 2 companies are wondering why should they really take a free zone benefit, because their income will be anyway covered under Pillar 2 and subject to 15%. But in this case, if the free zone company is under 0% tax rate, so there is no corporate tax liability under for the as a QFZP, but this company can still claim this credit against the Pillar 2 tax liability. So direct benefit, direct credit, and reduction against the Pillar 2 liability. So it is something very factual, of course, depending on your facts, but this can give you a straight benefit. And any unutilized tax credit after all these setups can be taken forward or can be transferred. And when you transfer it, transfer provisions are very similar to how we see the qualifying group or transfer of losses. So if 75% of the shareholding is directly or indirectly owned by the two entities, by the same person, then one entity can transfer to the other entity this R&D tax credit. But this R&D tax credit which is transferred should not exceed the tax liability of that transferee's company. If it exceeds for any reason, the balance gets forfeited. You cannot return it back. You cannot do anything or carry it forward. So one has to be very, very precise when the transfer of this R&D tax credit arises. So this is how the sequencing broadly of the utilization rules will be. Moving on to the next slide. Yeah. So there are various provisions, and one wonder how the R&D tax credit will interact with these other provisions and how the compliance will look like. So first or foremost is of course Pillar 2. So this is a very key question which most of the Pillar 2 companies or big groups are asking, that under Pillar 2 how will it interact? So under Pillar 2, there are two ways broadly, who are familiar with the Pillar 2 provisions will know, in which these incentives can be very beneficial. One is under side-by-side package, if that is introduced, which has been adopted by UAE currently. And other is a qualifying R&D incentives. So qualifying R&D incentive can only be when it is a refundable incentive, where you get cash back from the government. So in these two scenarios, there's a direct, or otherwise, of course, the one point which I discussed, the example of free zone versus Pillar 2 liability. Those kind of a cases where you will get direct benefit. So side-by-side package, just to update to the group, is already adopted by UAE. And then as a next step, the OECD has to list it. UAE as a country who has adopted the substance-based tax incentive rule, as a side-by-side package. So once that is listed by OECD, then this immediately becomes available. And in what happens in that case, this incentive is actually added back to the covered tax. It doesn't reduces the covered taxes. It actually gets added back. So there is a positive impact on the ETR calculation and you get the benefit straight away. In the case of qualifying R&D, which is refundable, which I mentioned, so far the government is calling it as a phase one introduction of R&D credit, which is non-refundable. So in that case, it doesn't give much benefit uh, till the time it is made refundable. So that we don't know when the phase two will come. The government has not yet indicated. But as far as side-by-side package or the substance-based tax incentive is concerned, we are hoping that that should be listed soon with OECD. And once that is listed, it is straight away a benefit, even for the Pillar 2 companies. Within free zone regime, how does it interact? One example which we saw, that if free zone company is not paying but Pillar 2 liability is there, you can claim the credit. Even those free zone companies who are qualifying free zone companies and subject to zero rate, but in case they land up on some of their IP income, 9% taxable, taxes, even then they can claim against that income this credit. Tax group expenses and headcounts, how do that interact? We in a way already covered that it's a one legal person, so expenses and headcounts are aggregated in a tax group, and accordingly the benefit is determined. From transfer pricing perspective, any related party transactions, including cost contribution arrangement, has to be at arm's length. So that is again intertwined in the R&D provisions as well. Even for the business restructuring transactions, R&D, if we see the provisions, it allows even in the business restructuring cases to utilize the credits that can be transferred as business transfers, provided all those conditions which we see in Article 27, all those conditions for business restructuring are satisfied. So this is how it interacts with the restructuring provisions. Going to the next slide. Yeah. Now the next question comes. So this is broadly how I hope it gives a decent clarity. Although there are, as I said, there are a lot more many details also which we may not be able to cover in 1 hour. But it gives a very good think indication how this R&D credit works. But the next immediate question comes. Okay, we can determine the expenditure. We can assess
The
the
REIT,
Yes, please.
sorry, not intended by mistake.
Okay, okay. So the next question comes, what are the compliances? What the company should actually do at the ground level once they do the assessment and determine the total expenditure. So the documentation required is indicative on the screen as you see, and if you see the regulations, it expect a very detailed documentation. So a general plan or some general basic documentation will not do any good. You need to go very in detail to justify your claim. So it could be project descriptions, work plans, governance, documentation, project HR plan, budget, costing, subcontracted plan. So all these, as you see on the screen, even the cabinet decisions say even the visuals, if they are relevant, even the visuals, pictures of related to R&D should be kept. So all those in detail, the technical documentation needs to be maintained, for which, of course, the tax and finance team will have to work with the technical teams involved. Financial documentation should be kept, cost breakdown, detailed analysis, R&D staff timesheets, for which you may have to interact with the, sometimes HR department also, financial records, invoices, payroll related information, receipts, ledger. So all these adequate supporting should be there from finance perspective. Tracking systems should be there, because even when the R&D council will give you the approval, it will track how it is working and how you can substantiate that all these expenditure and employees are actually working for this project. How do you ensure that? And you are not using the employees which are not working on this project to claim the benefit. So all that tracking will be important. All the teams have to collaborate together. It can be tax team, finance team, technical team, HR team. So all these teams have to work together and collaborate to ensure that all the documentations are maintained and are available. Audit focus areas. So even if you have claimed, you have done everything and you claimed in your tax return, you have the pre-approval, you should be ready for the audit. Audit can still come, and the tax authorities or even the council may further ask. There is a provision says that the council has the right to ask about the future progress, whether it is as per the approval or not. So they can always even come back to you after the claim. So you should be also, focus on the audit areas, what all may be required. So keep in a very systematic way all the records that they meet the regulatory requirements and standards. The cost allocations are accurate. All those, should be kept ready even from audit perspective also. And all these records has to be kept for 7 years post from the year in which you have claimed, this credit or when that expenditure was incurred. And it has to be provided either to the council or FTA, whosoever is coming back to you for those questions. Yes, moving on to the next slide. Yeah, next slide. So accounting of R&D is very important. So how you classify the expenses, how systematic you are in capturing the expenses in a proper head will be very relevant. You have to be also very careful that you keep the routine work related expenses and R&D activities separate and don't mix the two, because then it is very difficult to then justify. Identification of eligible cost will be very important. The record keeping we already discussed, audit readiness we already discussed. So all these elements has to come together and then you go and make the claim. And as we have seen as a tax professional, many times the challenges don't come from the documentation gap, come from the documentation gap actually, rather than the lack of intent. So I may be doing everything right. It is actually an R&D activity and I have all the intentions to make only the right claim. But in case I do not have the proper documentation to prove to the tax authorities that intent or that, the right activities may not be any good. So the documentation is the key. So you may have R&D activities but may fail if documentations are not proper. And one more thing which I will highlight here is there is in a way a kind of a deadline introduced in the law, because the claims have to be submitted within the due date for the submission of the tax return or the top-up tax return. If it is not done, then you lose the claim forever unless the FTA in exceptional circumstances may allow. So to that extent, it becomes a deadline that your last date to make the claim is the due date of the tax return. And what you need to do before that, you need to do the assessment, go to the R&D research and R&D council to obtain the pre-approval, keep all the documentation ready, and then make the claim in the return. So to that extent, the sooner you start, the better it is, so that the documentation are maintained as and how you proceed in the year. Moving on to the next slide, we still have 9 minutes, so I'll just quickly conclude with this. Yeah, so this is also very important. Since there are caps and each cap applies per year per qualifying entity. So many times immediate thought is, why don't I divide the activities in 2, 3 entities and then use the cap, multiplied by those many entities. So the law has pre thought about that, and it does give the provision similar to GAR that any artificial separation of business, will be questioned and will not be allowed. And if the authorities feel that there is artificial separation without any proper commercial reasoning, then they can reverse or adjust the arrangement. They can reverse even the credit which you have already used, and they can also cancel any unused R&D tax credit and will not allow it to be carried forward. So when you are doing the R&D or splitting it into 2 activities, you should keep in mind that you should be able to prove the genuine commercial reason, whether all the 3 entities which you have split into are still continuing with the same kind of activity which they were doing consolidated, or there's something more. Even financial, economic, and organizational links will also be important. So this is specific to the splitting of the business. And there is, of course, general anti-abuse provisions are also there, that overall, if you are taking, even as a single taxable person, you are making your arrangement in such a way that you get R&D tax credit, whereas you may not be the right claimant of that. So if the tax authorities feels that it is not a genuine claim, then they can again do the same thing, may adjust or cancel the arrangement, claw back whatever benefit has been given, and cancel any carry forwards. There are certain blockers and clawbacks in terms of, in case the qualifying entity stops being a taxable person within 5 years from the last claim of R&D incentive, or it becomes a qualifying free zone person within 5 years, or it elects for small business relief, goes into liquidation, or moves into tax residence outside of the country. So in these cases, the R&D tax credit can be clawed back. So this is what the provision says, which is incorporated there. Moving to the next slide. Yeah, this is very important because having discussed everything in theory and having discussed what is there in the legislation, the question still remains, okay, show us something practical, something real, what could be covered, as an example in the R&D tax incentive. So you can see on the screen some very practical examples. So just to give you a background of this slide and how we have picked up these examples. So UAE R&D credit is very similar to UK R&D tax credit, and in UK, the R&D tax credit regime is there for decades. So there it is tried and tested. It has been claimed from the authorities and it is very well settled. And it is also based on Frascati manual. So these are the examples that we have picked up from the UK practice. So these are tried and tested practical examples who have qualified as research and development. So out of all this, I will not go through each and every one, but I would definitely like to highlight the construction one. So this is something which, as I was mentioning, many people may not realize that they may be doing R&D activities. So construction companies or the, those who are into construction business may think what R&D they will be eligible for. But if you will see on the screen, if the construction groups, the big construction groups, they are advancing energy efficient building systems and life cycle modeling for net zero carbon goals. This can be covered in R&D. If those companies, construction companies, are improving sustainable material selection to reduce waste and increase recycle content, could be covered. Developing building information modeling capabilities for enhanced digital integration, again, can be covered. So these are some of the very general example which can be covered even in water security. If you see, improving leak detection and non-intrusive repair for water infrastructure, these kind of projects can also be covered. So nothing to do with the industry, just the activity. You have to really zoom in, talk to your technical people to see whether there is a potential or not. Moving on to the next slide. So these are again some of the example which many times the companies may overlook because they don't look like an R&D, but there can be a very good case to claim the R&D expenditure. It could be feasibility and prototyping, cybersecurity, innovation, advanced architecture, and various others, as you see on the screen. So to bring this full circle, we started today, I think, by challenging a common misconception. This R&D tax incentives are only for laboratories. So I hope we have covered that and addressed that. And we saw how it works and how genuinely activity-based incentives will help, and it will, have far broader implication than most people will assume. For those you in practice and you are advising your clients, I will encourage you to start having this conversation proactively with your clients. Many of them are likely running qualifying activity today without even realizing it. And for those of you who are in industry, I would encourage you to take this back, internally and start the conversation with your finance and technical teams about whether your organization activity could qualify. So we had, in fact, a discussion in one of the company's case where the internal project team reached out to the tax team, internal tax team, after hearing it out from the public domain that this incentive is there, and they asked the tax team why the tax team did not tell them, because their project budget gets reduced if they get this credit. So that way also it is relevant internally to remain collaborative. So you should start that discussion, start informing and letting the technical teams and the project team knows that this benefit exists. And of course, this is a younger regime, barely a few months old, as we all know. And like any other new piece of legislation, there will be interpretative questions and practical challenges as it matures. And so we should keep this conversation ongoing because I highly suspect that this won't be the last time that R&D incentives comes up in this forum. So thank you with that. Thank you once again to Smith and the Institute for this opportunity. and it's been a privilege. Now I will hand it back to Smith to open the floor for questions or any other points that the participants have. Thank you.
Thank you, Sarika, for this insightful session. Please feel free to provide your questions if you have. I'll see chat box if we have received any questions.
Regarding approvals and pre-approval process, how long does it take, and are there any approvals received already? So to the extent I know, there are no approvals received yet, but the forum or the website of the council was opened, and they have given step-by process what all documents needs to be submitted and how it needs to go. That website is also sometimes it's on, sometimes, so they are, I think, also in the back end working on the website and the various details. So sometimes you need to use a different browser to access that website. I can share with this group the link to that website. So no approval yet received, all under process, and most of the clients are actually doing the assessment. And once that is done, then they will apply. So we have done few assessments, and we are in the process of making those filings with the council. So to answer your question, there is no indication on the timelines. The council doesn't give any timelines officially anywhere on the website or in the provisions. So we don't know at this stage. That is why starting early and making the filing early, is advisable, so that even if it's a longer term approval, especially in the initial cases, you are still within time to make the claim before the tax returns. So I hope that answers the questions. Any other questions? Okay. So this is, I
Just
think, a
to add
general
here,
question.
hi,
Hi.
hi Sarika, thank you so much. It was very insightful. Just to add, like I had some information. I was speaking to ERDC team, so they are in the very final stages of finalizing the tool, and it should be out very soon.
Correct. So you do see a lot of,
Yeah, that
hiccups
prototype
when you
version is out.
access.
Yeah,
Yeah. But it is very much coming.
yeah. The final fine tuning is happening, and
Yeah.
UAT is undergoing, so it
Yeah.
should be live very soon.
Correct. So I think that's it. No more questions. But yeah, even if
Yeah.
you have any later questions, feel free to drop on the chat. I will try my best to answer those.
Thank you. Thank you, Sarika.
Okay.
Thank you very much for the insightful session, and I'm quite sure that every one of us have gathered some piece of advice on how do we proceed further within our organizations or with our clients on this piece. So, thank you very much. And participants, we will. I'm not sure, Sarika, can we share across the deck to the wider team
Yes.
or?
Yes, we can. I will share with you the, the PDF version. You can circulate.
Sure.
Yeah.
So, thank you very much for this. And it was nice to hear you.
Yeah.
And
Thank
if
you.
any of our participants have any other questions, we are there in the group. We all know we have created a WhatsApp group so that we can, in this region, especially in Abu Dhabi, we can coordinate with each other as a consultants or as somebody who is into industry and coordinate better within ourselves. So we have more sessions which are lined up in the time to come, and we'll surely meet you in the upcoming sessions. Possibly the next one will be in a physical one rather than being in a webinar version. So thank you everyone for your participation.
Thank you, Smith Joshi, for being a moderator and taking this initiative. And thank you, Sarika. We really enjoyed and hope to see you in a face-to-face meeting. So thanks a lot. Yeah.
Yeah. Thank you.
Thank you so much. Thank you,
you.
everyone. Have a
everyone.
good night.
Thank
Good night.
you. Bye.